Given widespread return to office mandates, flight to quality, not only of the buildings but also of the landlords, and historically low development and deliveries for the next 3 to 4 years, we feel like we're in a very good position to capitalize on the new environment, and we're excited about the opportunities ahead.
Hello and welcome to the REIT Report. I'm your host, Sarah Balsam-Keto. My guest today is Sherry Rexroad, CFO at Piedmont Office Realty Trust. Before joining Piedmont last year, Sherry served as CFO of Store Capital. Prior to that, she spent a decade at BlackRock Global Real Asset Securities as Global Head of Business Development, as well as Co-Global Chief Investment Officer and Chair of the Investment Committee. Sherry, really happy to have you back on the podcast today.
Thank you, Sarah. I'm so happy to be here.
So, Sherry, given the fact that CFOs today are operating within environments that include shifting interest rates, recession worries, and geopolitical tensions, how do you work around that volatility and remain consistent on strategy?
It's really important to differentiate between short-term volatility and secular change. Short-term volatility needs to be managed and or monitored. It can be a distraction if you let it be. An example of managed is, for example, hedge your floating rate debt. An example of monitored is geopolitical tensions and recession worries. However, thinking about the underlying trends, anticipating them even, is critical to setting strategy and can be an impetus for changing strategy. For example, the demographic shift to the Sun Belt and Piedmont's strategy to focus on core markets there. Between 2019 and 2022, Piedmont shifted $1.4 billion of assets, roughly a third of the portfolio, out of Chicago, D.C., Philadelphia, New Jersey, and Cambridge, and into Atlanta and Dallas.
Great. And as CFO, what are your priorities for Piedmont in the next 12 to 18 months?
As a company, creating and leasing beautiful spaces that encourage collaboration is our mission. We call that placemaking. My job is to attain the best cost of capital for the company to enable its mission. So I'm focused on balance sheet management and investor communication. In the first quarter, we added Fitch to our lineup of rating agencies, recast our revolver for a 3-year term with 2 one-year extensions, paid off a $250 million term loan, and added $125 million to another existing term loan that matures in 2027. We also added 2 6-month extensions to that term loan to provide refinancing flexibility at maturity. The result is we have no debt due until 2028 and are actively working on balance sheet management to avoid any concentration of refinancing in the future. We are constantly trying to optimize the composition of the portfolio, and we have a long history of recycling capital. That requires an ongoing, objective review of potential acquisitions, dispositions, and redevelopment capital. I sit on the investment committee, and I and my colleagues are very disciplined around how we spend our shareholders' capital. It's a precious resource, and our stewardship of it is something we don't take lightly.
And what are office leasing conditions on the ground looking like for Piedmont today?
Well, it really depends where you are, and not just what city, but what submarket and what building. Our Sunbelt markets continue to be vibrant, and our properties are well located and highly amenitized to attract tenants. The overall vacancies that you see in many reports are a bit deceiving, as they combine submarkets and include many properties that are on their way to being obsolete. We encourage investors to peel back the onion, and they'll see how the research data is skewed by the obsolete buildings. The best 5 to 10 assets in any market that offer appropriate amenities are in high demand. When we pair the fact that demand is approaching pre-pandemic levels and that there is no new development planned until the end of the decade, the result is high demand focused on the top quartile of assets. It's also interesting to note that the demand is broad-based across industries and that large tenant activity is increasing. During 2024, we completed 2.4 million square feet of total leasing, the most leasing we have completed on an annual basis since 2015, and we grew cash basis same-store NOI by 2.6%, with both metrics well above our original projections and guidance for the year. We've now leased about 10 million of our 16 million square foot portfolio since the beginning of the pandemic.
And Sherry, how would you describe the current capital market backdrop for Piedmont, and how active do you expect to be regarding acquisitions, dispositions, and reinvestment?
We've openly communicated our intention to further increase our exposure to the Sun Belt through our disposition program. We are currently about 70% in the Sun Belt and see that moving to 85% in the near to intermediate term. We've also heavily invested in our portfolio, and most of our properties boast redeveloped lobbies, meeting spaces, gyms, and food and beverage outlets. Given our cost of capital, any acquisitions at this time are likely to be in the form of JVs, where Piedmont would be the operator redeveloper, but only required to invest 10 to 15%. Historically, we've bought and sold approximately $400 million per year, and we expect to see more opportunity in the second half of 2025 and into 2026 as the capital markets ease.
What are some other issues that you're dealing with as CFO that extend beyond the traditional scope of finance and accounting?
Well, Sarah, I take people management very seriously, and I put a fair amount of time into it. IT also reports to me, so I'm spending time looking at whether we have the best systems to support our teams, whether changes are needed, and how to keep our systems secure in the future. As I mentioned, I also sit on the investment committee, which weighs in on strategic and capital allocation decisions, including acquisitions, dispositions, large leases, and redevelopment projects. So while my title is CFO, I have the opportunity to be involved in many of those decisions that are outside of the traditional finance and accounting scope. That's one of the elements that really attracted me to this role and to Piedmont specifically.
Going forward, how do you expect technology to shape the CFO role more broadly?
I personally think there's still a lot of work to be done in basic prop tech for asset classes that aren't commodities. And by that, I mean property types that have unique spaces like office and retail versus property types that have multiples of similarly shaped and finished units like hotels, storage, and multifamily. It's an evolution, and it's one that continues. There's a lot of focus on AI in our industry and in the world in general, and it has the potential to eliminate a lot of lower-level job functions, allowing people to focus on the interpretation of data and on strategy. That's certainly true of the finance and accounting roles. I'm hosting a panel on prop tech and AI in the REITverse later this month, and my panelists are in a variety of property types. From those discussions, I can tell that no one has the magic bullet yet on how to best use AI or how to use it with a consistently positive investment return. But there's a lot of experimentation and many new products to consider.
And Sherry, what are among the most common themes or questions that investors are raising with you today?
Investors always want to know about our leasing pipeline and color on our markets. We're very proud of how the portfolio has performed through tremendous adversity in the office sector. Given widespread return to office mandates, flight to quality, not only of the buildings but also of the landlords, and historically low development and deliveries for the next 3 to 4 years, we feel like we're in a very good position to capitalize on the new environment, and we're excited about the opportunities ahead. There's been a remarkable change in sentiment around the office sector, and there's now a focus on internal and external growth, whereas 9 months ago, the questions were about utilization rates and return to office. It's great to see the positive sentiment change.
Sherry, was there anything else that we didn't cover that you'd like to mention?
No, but I really thank you for the time. I've enjoyed being here.
Excellent, Sherry. Thanks so much. And to our listeners, if you enjoyed this episode, please subscribe or leave a review on your favorite podcast platform.